Let's touch base with Ashish Parthasarathy, Head Treasurer at HDFC Bank. Joins us on the phone line to throw more perspective on the trajectory of rates going forward from here. Ashish, you have hiked your base rate by 20 basis points and cut your deposit rates by 25 basis points in 46 days to a 6-month bracket or the tenor. What will be the impact of the same on the margins?
I think, we have a margin range which we normally operate in, a stable margin range, and even these changes should keep that our margins in that same range.
Your margins were significantly lower quarter on quarter. It came in at about 4.3%. Post the recent hike in the base rate, would you be able to maintain margins at 4.3%, or would there be a change there?
We don't give a forward guidance on margins, but as I said, we operate in a range and we should remain in that range. I will not be able to tell you what will happen exactly this quarter, since we don't give any forward guidance.
Okay. So two questions rolled into one, Ashish. One, would you expect further rate changes by the Reserve Bank in the coming policy? And two, would any hike or cut in the base rate or the deposit rates respectively happen post RBI action, or could there be some tinkering in between that as well?
So the way the base rates move, as you are aware, the base rates are reviewed by banks at least once a quarter. That's what the prescription is. And whatever components go into the base rates, which could be for us, which are deposit rates, the policy rates, as well as the yields on SLR. So all that then comes out. The formula is fixed. It's only the rates change, and whatever the outcome of the formula is what the new base rate comes to. As far as RBI policy is concerned, I think there's extreme clarity that the policy inflation will determine the path of the policy. Inflation is high, and that's why rates have been hiked. If the inflation actual inflation rates come out to be higher than what is currently forecast, then you could see a hike in rates. Else the rate should remain steady.
What's the take on liquidity right now, Ashish? I mean, just wondering if you believe that RBI could take any further steps to ease liquidity.
So right now, I think liquidity is eased marginally, and it is possible that given the FCNR flows which are expected again this month, you could see a somewhat better liquidity during the month. So very unlikely that RBI is going to take any steps to add to liquidity this month. There could be steps once you go into December when the advance tax outflows take place.
Post the recent monetary policy, call rates have come down significantly. Where do you see call rates in the next 3 months, and how do you see short-term rates impacting your cost of funds?
So call rates obviously will, however, between the repo rate and the MSF rate, are slightly higher than the MSF rate. Once we go into December, as I said, post-advance tax, you could see it more at the MSF or slightly higher than the MSF rate, unless some other liquidity measures are taken in the interim. Right now, yes, there could be somewhere in between the repo and the MSF rate.
Just a quick perspective on the 10-year bond yield as well, Ashish. At over a month high, what is your view on 10-year yields? Do you think we could see levels of 9% plus in coming months?
So 9% plus is slightly far off, but yes, there would continue to be pressure on government bond yields in the upward direction given the supply. Unless again there is a game-changing move like India being included in the world bond indices, where you see inflows from investors outside India coming into the bond. So unless there is a game-changing move, you could see pressure on yields for the next 2-3 months.
Ashish, thanks so much for joining us today on such short notice and giving us a view. Appreciate you taking the time out.